Do you own or run a hospitality business? Regardless of whether your hospitality business is a small cafe employing just a few people or a large hotel with hundreds of staff on the payroll, it's important to make sure you get your bookkeeping right. Accurate and efficient bookkeeping keeps you compliant with taxation laws. It also provides you with the information you need to measure how your business is going and devise strategies for improving your profitability and efficiency. If you own a hospitality business, then the guidelines here are a good indication of what you need to be doing to ensure you get the most out of your business's bookkeeping. Keeping your books up to date isn't just a statutory requirement from the ATO. It's also a prerequisite for successfully managing the financial side of your business. Without updated books, you cannot track your business's performance or generate any useful management reports, which means you'll be left running your business blind. The more regularly you maintain your books, the better. However, for the smaller hospitality businesses, there may not be enough bookkeeping work to justify reporting more regularly than, say, once a month. However, in larger hospitality businesses, missing even 1 week of bookkeeping and reporting can mean that problems are not highlighted before they get out of control. If you fall into a pattern of irregular bookkeeping, the cumulative effects that it can have on your business's financial success have serious repercussions. Compliance reporting and BAS lodgement is a legal requirement for every hospitality business. In smaller businesses, so long as your books are up to date and accurate, your quarterly BAS lodgement shouldn't take you more than 15 minutes. However, in larger businesses, it's likely that you're at the stage where your annual PAYG withholding obligation is going to be greater than $25,000 a year. If that's the case, you'll need to ensure that you lodge your BAS on a monthly basis. Once again, up-to-date and accurate books will make this task so much faster. It's important to ensure that your payroll is compliant with workforce and taxation laws. This can be more complicated if you use casual staff and contractors. It's very important as well, if you do use contractors, that you understand the definition of a contractor versus an employee. Be careful to ensure that your staff are paid the correct award rates and check whether they have another job and if they're eligible to be claiming the tax-free threshold. Always keep your work cover insurances current. If your business is bigger and you have a lot of employees, you'll no doubt benefit from a more integrated workforce management system that manages your scheduling, your timesheeting, and your payroll in one. This will not only allow you to process your payroll more efficiently, but also help you to ensure your profit isn't negatively impacted by common problems such as overstaffing, understaffing, or having to pay overtime or other penalty rates unnecessarily. With any hospitality business, it's important that you maintain an effective cash flow forecast. A cash flow forecast is an estimate of the amount of money you expect to flow in and out of your business, including all your projected income and expenses. A rolling 12-month cash flow forecast always projects 12 months ahead, so you can have as much foresight as possible for strategic planning. And this is the type of forecast we recommend for all of our hospitality clients. A cash flow forecast showing monthly monetary movements is usually appropriate for hospitality businesses with under 20 employees. In a larger business, you should have a cash flow forecast showing monetary movements on a daily basis. By monitoring daily movements, you won't be hit by any unforeseen cash flow shortages during the middle of a month. Shortages that you would have been unprepared for when you're measuring monthly movements, as cash inflows later in the month would balance everything out. Your budget is a forecast of your income and expenditure. A variance analysis highlights discrepancies between your forecasts and your actual income and expenditure. This allows you to identify and address the cause of problematic discrepancies so you can prevent them from occurring again. In smaller hospitality businesses, a monthly variance analysis is usually sufficient to manage the business's finances. However, in slightly larger businesses, it's better to conduct weekly variance analyses. This is because your turnover is likely quite high, so any discrepancy between your budget and your actual income and expenditure can add up and become very problematic very quickly. By conducting a weekly variance analysis, you can identify discrepancies and address the causes ASAP. Sales analysis and inventory management allows you to gain a reasonable idea of what stock levels you need week to week. Overstocking can negatively impact your cash flow, while understocking can affect your sales and has a potential to harm your business's reputation. That's why it's important to tread the middle ground. In a hospitality business such as a restaurant, sales analysis and inventory management also helps you to understand which dishes and drinks are popular and which are not. You can then measure the profitability of each product line. Monthly sales analysis and inventory management is usually appropriate if your hospitality business is smaller. If your hospitality business is larger, you'll also have large volumes of inventory, and these will move and change very quickly. It's therefore important to use weekly sales analysis and inventory management. Hospitality businesses of all sizes benefit from ratio analyses. For new, smaller businesses, ratio analysis can sometimes be even more useful than a budget with a variance analysis, as accurately forecasting forward can be difficult. Ratio analysis involves using industry benchmarking data to analyze your business's health and performance. For example, benchmarking data suggests that the cost of goods sold at a restaurant, such as ingredients and alcohol, should be equivalent to 35% of your business's revenue. In a motel, employee salaries and wages should be equal to between 15 and 17.5% of your revenue. By analyzing your business's financial ratios, you can identify areas within your business that are affecting your profitability and cash flow and take action to improve them. If you would like assistance with advancing the financial management of your hospitality business, we're here to help. To learn more, call us today on 1300 313 397 or request a call back on our website.